You have to go through a process of studying it. You have to have the real rules, not just make it look like I have a chart that looks like ICTs now. It doesn't work like that. You have to know the logic behind it. Okay, and that's why I talk to you with a long-winded approach, because I give a shit. I want you to learn it correctly. I don't want to just go out here and make videos for the AdSense of it. You making you. What are you gonna say when I stop making videos? What the hell am I doing then? Right? I'm not delivering pizza, right? I want you to learn. I want you to learn it correctly, and that means it's going to take a lot of lecturing in detail, and some of it's going to be boring because you are not at that point of which it means anything to you yet. But when you start to try to use it and your heart's in trying to figure out how to use it correctly, you're going to listen to these lectures, and then it's going to be like, wow, I can see where I was making a mistake there, or I wasn't considering that factor, and now I can see it better, and now you're going to go out and do it better now. That's the proper learning curve, but some of you just don't want to do that. You want it to be right away real quick, and it doesn't work. It doesn't work like that. So there's our daily chart. So just be mindful of that here. This right there, you see that? That, friends and neighbors, this is a real liquidity void. There is no wick, no tail, no body. That is a real liquidity void. So if we continue lower, and I'm not calling a low, I'm not trying to pick a bottom, this is a significant draw where price can go down into. And if it gets into that, because there is no wick and there is no body between these two candlesticks, I would expect to see a lot of acceleration quickly until we get down to this candlestick's close. And then treat all this in here as a low resistance liquidity run, meaning that it can do a lot of the go down a little bit, come back a lot more, go down a little bit, come back a lot more, where it's not just real quick slicing through. Okay, so just be mindful of that. And also, if you factor in what I taught you, because this is a daily chart here, we have this liquidity void. You want to do your ranges. I gotta take all these off. Pardon me 1 second. All right, so now we have our high, low, consequent encroachment, upper quadrant, lower quadrant. So now we have levels that are much more meaningful to us. So these are all specific price levels that you should have on your S&P chart. If we take out this low, these are going to be impactful until we get down into the close of this up close candle and the open of that candle right there, which is essentially the open lining up with the consequent encroachment of that liquidity void. So essentially what I'm saying here, for folks who don't see the importance of even caring about this area, because there is no trading at all. And I know some of you are thinking, well, Michael, it's so spotty. It was not really being traded all that much then. So why would you use that? Because it's there. Because it's in our active front contract right now. Until we get to expiration in December, which is weeks away, month and a half away. A lot of things can happen. Like it could get way beyond this level lower than just that. But because of purposes of looking for where the market could draw to, why it should draw there, on a horizon that could be measured with, practicality. We're talking about the entirety of the month of November still, and half of December before we roll over into March 2024. So when this December contract expires, we'll be rolling into March 2024, but there's a lot of time between that becoming a factor and becoming the front month of S&P trading versus where we're at right now. This is a factor that you need to be measuring. So I'm always looking at those spotty parts of the contracts that I'm trading during times when it was illiquid, because the market's going to refer to those price points. Why? Because the algorithm is booking price on what? This contract month. It's not doing it on March. Everything that's being controlled and manipulated is done on this contract right now. And when we roll over in the March 2024 contract, All the parent contingent ideas that deliver book price will be based on that March 2024 contract. It's not rocket science, folks. I mean, I know it sounds like science fiction to a lot of you because you have a vested interest in this industry. You don't want to be laughed at by your your coworkers. You believe in an algorithm? You silly son of a bitch. Whatever, dude. Stay in your clicks, but you ain't never gonna have this level of precision. All right, so let's drop down into a 4-hour for ES. All right, so we have a gap down here. What kind of gap is that? Does this high, look at the high up here, okay? Look right up at this price level. That candle's high comes in at 42.5. The low on this candle, right here, the low on that candle comes in at 43.5. So there's a difference or a real gap, a liquidity void of one handle. So from 43.5 to 42.5, there's one separation between those two candlesticks. That's a real liquidity void. So you want to have that on your time frames, at least the 60-minute and less. That might be a factor for price to want to go back down in there and revisit. Even if we are going to make a low, I'm not saying we are, but even if we were to make this low, intermediate term or long term, I would be still factoring an interest in that between now and 8:30 on Friday. There's a volume imbalance inside of this fair value gap with volume imbalance on the daily chart. Remember this shaded area here? That's on the daily chart. Let me go back up real quick. I'm sure I'm going to lose some of you. This volume imbalance right here and this candlestick's high and this candlestick's low, that would be normally the fair value gap. It would look like this on my chart normally. If there wasn't a volume imbalance there, that's what you would see. But because we have the volume imbalance, we're factoring that in too. Okay, so now let's go back down into the 4-hour chart. We have the volume imbalance there that's visible as well. So even on the daily chart, dropping down to the 4-hour chart, you can still see it's very, very distinct. There's no bodies laying between these two candlesticks, close and open. So it could draw up into that this week, is what I'm saying. I'm not interested in taking any more trades, but this level down here, that volume imbalance, that liquidity void, the actual gap that has a one handle gap or 4 ticks of a gap, you should have that highlighted on anything from a 60-minute down. And this area right up in here, since we can see it on the daily and on the 4-hour, this is what you should have on your chart. So there's your up and down, your premium and your discount, as it is right now. And that's just saying that we don't need to go outside the range of this swing high. Why this swing high? Because it's the swing high prior to this one, and it's got a higher, it has a lower high rather to the right of it and a lower high to the left of it. So this swing high is important to me. If it wasn't there, then I'll take my attention to there. But this is the only one that has a swing high until we get to this point here. But we're not interested in this by in and of itself because the volume imbalance here on the 4-hour, which is what we're looking at, and it's also the same area on the daily. So this little segment of price action is above where we are at market right now. Market price is here. So discount, my interest is that liquidity void of one handle or 4 ticks below us. And the premium level is this volume imbalance. And now, how would I use that information? I would look at that at 2 o'clock and the 3 o'clock and the 4 o'clock and see, does it want to draw to either one of them? Does it give me a silver bullet? Does it give me something tomorrow morning that's going to be obvious that's trying to get to either one of them? And if it offers you a framework that allows for 5 handles and not a lot of risk, then there it is. So for the folks that don't have the skill set to be able to take a trade, you simply use these levels to study which one does it gravitate towards. And then look at the price action after it does that and see, was there a silver bullet there? Was there a Model 22 entry? Was there an optimal trade entry there? Okay. Or was there a breaker that you can use to get to either one of these levels? And that's how you start. Because if you don't know what you're doing, you have to have a framework on how to trade, how to practice and log things. And that's what you're doing. And in the beginning, it's going to seem counterintuitive to be doing that because you think you should be pushing buttons in a demo account when you're going to just simply feed yourself bad experiences and learn nothing except for concern for the outcome, which is what you want to avoid before you learn how to follow a model, and then certainly before you trade with real money. So again, just a reminder, if you're learning anything, that little thumbs up button, that's a testimony that you are learning, not just listening. All right, see how clean this is here? That in there with the bodies to this right here, that's relative equal highs. I like that. So I think that this is something that you should have on your chart for a premium, meaning that it's likely that they'll want to go above that. Folks that see this high today, they're short. I wouldn't want to be short in this, but it's likely that they might, at some time between now and, I don't know, Friday, they'll want to clean that area up. If they do trade through that, then I would want to see, does it want to stay above that and not quickly reject? Because as long as it doesn't quickly reject, we would anticipate trading up into that area here, which is the inefficiency that we've seen on the daily and the 4 hour. Now we're on the hourly chart, and now this becomes what? Look how it's refining down into a actual liquidity void where there is no trading between two successive candlesticks. So between this candle's low and this candle's high, there is no trading, zero booking of price, buying or selling, nothing. So this is a real what? Liquidity void. Should it be defined just like this? Is it accurate to leave it just like this? No, you shouldn't. Why? Because this candlestick here did what? It pressed into it a little bit. So this needs to be augmented to show this candlestick's high. Then draw it back to this candlestick's low. That's the refined levels. So the void is between this candlestick's low and this candlestick's high, because between when this formed all through here, this candlestick went up into it by a little bit and went just above this candlestick's high. So the inefficiency is now redefined by this high and that low. So this is what you should have on your chart. Okay. All right. So 15-minute time frame. Yeah, this guy's long-winded, isn't he? If you were paying me, you'd want it to be just like this. Don't shortchange me on ICT. Don't be going shortcuts, okay? I want to know everything. All right, so we have, this is interesting. We have low, lower low, and this high in here. So if we get above, let's say we get above and sweep all this area here that we just outlined on the hourly chart, I would want to see, if it was the correct lower, I would want to see it be supported by this potential breaker. Okay, so we have a low, high, lower, low. If it were to take a run above that 41.87 level, it's allowed, it would be permissible for it to drop down into this high in here, but it would have to be supported by, let's go into the 5-minute chart. It would have to be supported by this up close candle here. Because that would be your bullish breaker. So, meaning that it has to go through that, show no respect of it, okay? So this is also something I'm going to talk about in my books, but just to prove to you, you shouldn't feel this over excitement about buying my book. I'm not trying to peddle to you to get more money, okay? But I'm going to teach you something here that I will talk about in the book. But because I'm showing it to you over a chart, it's going to be a little bit more impactful. You've seen me doing executions where I'll label a breaker, and I'm entering inside of the range that's defined as a breaker, whereas you classically have learned and seen me define the breaker being utilized after it gets above it and comes back down. Then you see me buy it. That's the low level understanding of a breaker. It's a very simple conceptual idea. But if I'm bullish, okay, if I'm really bullish, I can use a lower time frame entry inside of this, knowing that I'm positioning myself within order flow, that later on, if it comes back down and touches again, that could be a pyramid entry for me. But if it goes above it here by a little bit and rapidly trades down below this low here, then that to me is problematic for it to go up into the 4-hour daily and then refined area up here we have as that liquidity void. You follow what I'm saying? So there's an hierarchy to using all these things, and it's not an easy thing to explain for someone to watch one time and understand right away. Okay. See how fast we rolled up into it there? That stuff can happen at an instant, just like that. So there is liquidity resting right above that 10 o'clock high. You want to measure how fast it wants to reprice above that, if at all, okay? But this breaker is also something, if it fails to go higher, every one of my PD arrays can be used like an inversion fair value gap. Every PD array has an inversion aspect to it. So if we were, for instance, let's say this, say I was hardline bearish. I was really bearish. I could take a short in this as it's trading rate where it's at. I'm not saying that's what I want to do. I'm just saying that if there's an instance where I am bearish, I would sell in that like that. And if you watch me do the executions, and I've done this before for students, they're like, what are you using there? It's the fact that I'm looking at something that would otherwise be viewed, if it was viewed diametrically opposed to the sentiment I'm using in trades, it would be used bullishly. Same way I use with the retail logic. If I talk about a trend line phantom, where it looks so obvious that there is some supposed diagonal support or resistance, if I can clearly see that in the time frame I'm looking at, I know it's going to draw to the midpoint and draw to that liquidity. So what am I doing? I'm capitalizing and attacking retail logic. How's that rebranding retail logic? It's not. I'm opposed to retail theory. So I'm looking at it like I have a disdain for retail theory because it's bullshit. That's what's leading you astray. That's what you're losing money on. But you keep looking at it and coming back to it like a dog to its vomit, thinking I need to eat this or I'm going to starve. I'm never going to be able to do it unless I do it this way. And you have to put it down. Leave it alone. Don't touch it. Learn to identify where it's in price. And the way I'm teaching you how the market's likely to draw to specific price levels, that draw on liquidity, if that draw on liquidity is opposed to what you see from a retail perspective or theory, chances are that retail theory is wrong. That's what I'm trying to communicate. I'm trying to communicate that as a beginning basis point. Because if you can get to that point, it's real easy to hold on to learning and practicing until you get good at your model. And then it becomes really fun, because then you can go into any time frame using that model and find something that builds your courage up every single day, because you have something you can measure. So we have the little short-term high from today's intraday high. And then we're trading right back down into that breaker. So it's a 1 minute chart. What time is it? It's 1:32. What time did I start this thing? 11 something? Let's call it 11:15, so 12:15. So we've been going about 2 hours and 15 minutes. I'll try to wrap this up by the time we get to 2 o'clock. Keep going, ICT. Come on, man. Let's go to a daily chart. Look at the Dow. Dow. YMZ2023. All right, we have a small little fair value gap. What kind of fair value gap is this? Before I draw it out, what would you call it? Right here. What was that? What's that one called? What's the little thing I told you that you remember? Determine what is a specific fair value gap. A down closed fair value gap is a SIBI. An up closed fair value gap is a BISI. So this is a SIBI, sell side imbalance, buy side inefficiency. From here to here, right? Right? Is that right? No. What's here? Volume imbalance. So you have to incorporate that. So that's what you should have in your chart, okay? Now, because it's on what time frame, what's up here? What's this? This is a daily chart. You want to be able to add your quadrants, okay? So these are very specific levels. It's not a fucking zone, okay? It's not supply and demand zones where who the hell knows what you're supposed to trade off of, okay? It's very specific levels that we're looking for. So on a 4-hour chart, we drop down. Okay. So the market's drawn back up into this area here, right above this short-term high. This up close candle, I would not call that an order block. Why? Because it's outside the range of that daily fair value gap that's also incorporating the volume imbalance. So all of this movement back in here, I would discount all that, and I would look at a up close candle above this area here to be my bearish order block, which would be this one here. Okay, rules, folks, rules. That's what's going to be in the books. Not every up close candle is a bearish order block. So if we have our lower quadrant level here, does it want to get to that lower quadrant level? Does it do so speedily? And does it close above it when it gets there? If it doesn't, that's suspect. That means it might want to revisit all this down here. And this area here, between this down close and this up close, this little segment of price action right in here is a balanced price range. So it'll take a more meaningful move to get below this. So any retracements could be met with some kind of support in here. If we lose this area here and it comes back up and touches it, that is, in my opinion, potentially very bearish. But I can't stand the Dow. The Dow is very, very fickle. It's spotty. It doesn't want to listen many times what the other ones are doing. But it's usually very helpful when it comes time to looking for intermediate or intraday SMT divergences, where the Dow many times is the one culprit that will say, I'm not listening. I'm not going to make that lower low, or I'm not going to make that higher high, where the NASDAQ and S&P would. That is something that you want to add to your SMT notes, that if you have an SMT divergence that is using the ES as the divergence or the NQ as the divergence, those are going to be your stronger SMT divergences. What'd you just say? I just gave you some gold. True, yes, I'll take an SMT divergence if it's the Dow, if I'm really, really strongly convicted about the idea I think the market's going to go. But I usually demand ES or NASDAQ to be the divergence because it's a larger degree of stocks, because the Dow is only 30. And those companies are, they're not what they used to be, versus 100 of the tech stocks or 500 of the blue chip stocks that are in the S&P Composite Index. So there's a little bit more weight placed on my S&T divergences when I'm using it as a catalyst behind the ES or NQ being the diverging index. So if that index is one of the two, ES or NASDAQ, I'm going to have a lot more faith behind that SMT divergence than it would be if it was just the Dow. So if I'm seeing it on the Dow, I have to have other things really siding with me that it's going to move. Otherwise, the SMT is not going to do it for me. It's not going to be the thing for me to say, yeah, this is a good qualified trade. So just toss it in there at no extra charge. Just make sure that this is down here as your balanced pricing, okay? And a 60-minute chart. Man, I'm doing a clinic today. Shit, I should have charged money. Could have got myself some cheesecake. All right, so here we have the hourly chart. Now look how this run here. From here, run. Don't worry about the shaded area here because we did that after this forms. But look how it goes down here, runs up, trades above this high there. No inefficiency because it goes immediately down into the order block. But where specifically does it go? What is this? It's a wick, right? Wicks are treated as a gap or inefficiency. So if we treat this range, when I'm watching price move higher or lower, I'm looking at every single wick. Let me get this off here. Don't need the quadrants for this. When price was up here, and if we thought price was going to go higher, go look at all of the times I'm trading. When I'm doing my executions, I'm adding pyramiding. If there's a wick that it's trading back down into, you'll see me entering at it. Look where it goes, right there. And what is that little movement below it? What's that called? a mohawk. It's perfectly permissible. That's exactly what the algorithm's going to want to do to offer what? Smart money that has an algorithm that's going to handshake with it. Okay. Here's the conspiracy that most of you are going to say it doesn't exist. But I'm telling you, when you start looking for it like this, you're going to see it's there all the time. And then you're going to really have a problem sleeping at night because you've been believing in Bollinger fucking Bands. So right in here, we have a consequent encroachment. That price level is 32,806. The low here is 32,801. So we're only talking about what? 5 points? And this is on an hourly chart. An hourly chart, and you're only talking about 5 points deviation below a consequent encroachment level. Are you going to be wrecked if you have to trade with something that allows for a stop loss that's just above 5 points in the Dow? And trusting in a logic that where you're entering there should be some movement that supports your trade and it should run higher? What's this over here? What's this right here? Same thing, right? Same thing this is. So if you look at both of them, what is it doing here? It's overshooting this one, but it has to refer back to this one as well because it's also a wick. So it's a gap. 2 consecutive gaps in the form of a wick. So you have to look at that. That's real fucking order flow. You're not going to see that on a depth of market. You're not going to see that on ladders. You're not going to see it on volume profile. You're not even looking at this stuff. You're not looking at this, but I am, and I'm executing on it. My entries are fucking phenomenal. They're consistent. They keep happening all the time using the same logic. I'm teaching you how I'm doing it. If you're bullish, you're looking at these levels. Even if you have already positioned your entire trade and you're not going to add anything more, you're still going to look at price like this. As it's forming in each new candlestick, does it go down to that level? Okay, it's going past a little bit. Okay, it shouldn't go beyond that. Now it should start to reverse here and create a long wicked, candlestick bottom or low, or what we call it a tail, I guess. Okay, and then it does this. Wonderful. Then we open here. We trade down. What's it going to? This wick right there. Does it need to go to consequent encroachment below here? It could, but what happens if it doesn't and it turns and starts rallying? What does that indicate? It's really bullish. There's no need to worry about putting a stop loss right below that low now or trailed up to that point. There's a logic behind everything I'm doing. I'm teaching it to you, but it takes time to explain it. You have to see examples of me doing it. What's the logic that I'm using? Why do I trust that the market's not going to turn around at this point? I'm teaching all that to you right now. But it's true to form. I told you it's not going to be easy 1, 2, 3 application. Like you have to look at lots of things. And for some of you, maybe a lot of you, you're going to be like, yeah, fuck this. Just give me a supply and demand zone indicator and we'll call it a day. And hope I make money. Okay. Like I said, I'm not everybody's mentor. But for the freaks out there that simply want to know why this market's doing what it's doing, I'm teaching it to you. Look how clean these highs are. See that? Look how it ran right up into it. That's not random. So even if you were looking at this price action right in here, all these wicks and stuff, I love that. I love when there's these wicks and convergences of tails and candlestick wicks together. And I have a bias, and I have a draw on liquidity. You can enter in all that. What time frame is this right here? What is that right there? 1 hour, right? We're going to frame this. Now, granted, this is the part where you're going to simply have to give me some latitude here because I've already proven this shit this morning and for the last 2 years publicly. That's a draw on liquidity. If you start seeing all this back and forth in here and you see all these wicks, if you take that range here and we're on an hourly chart, draw that here and say you extend this out in time because you don't know how long it's going to take for your setups to form because you're waiting for a specific model. And we can drop down into a 15-minute time frame. Let me change this rectangle so that way you know what I'm looking at or drawing your attention to. We'll do it like this. Okay, so you can see there's a contrast, right, between this area here and this is a little bit more of a green hue. We're going to look at this area in here and see what forms. Because in here, order flow is accumulating new longs. Not because of depth of market, not because of volume profile, not because of anything else except for algorithmic handshaking. That's what's going to happen here, okay? And I'm going to show you what it looks like. Using that little shaded area in here, we're going to drop down into a 15-minute time frame. So the idea is the market's consolidating in here. It's consolidating with the expectation that it's going to allow for, quote unquote, smart money and their respective algorithms to handshake, dovetail together with what price is doing here. It doesn't fucking matter how many people are buying and selling. It doesn't matter how many orders are supposedly at these price levels on your depth of market. It matters not. All of that is a distraction. I'm taking your attention to what you need to be looking at, because everything else outside of price and time, you are literally being distracted. You're being fooled. It's a red herring. Everything is based on time. And when that price is in agreement with what you think it should be doing, drawing to liquidity. But ICT, you're talking about something that didn't happen. You didn't trade that. Right. What did I trade? What did I trade? NASDAQ. Did it perform? It performed beautifully, didn't it? But what is this indice doing? Similar things, right? It's following order flow. It's following the signatures that I'm teaching you and have taught. It's been out there for years now. In this area here, we want to study how price is being respected around specific discount arrays. So what's a discount array? A down closed candle, the midpoint of a wick, any fair value gap, or volume imbalance. Right in here, we have this wick. So you want to measure half of that. We'll just eyeball it. We'll say it's right there. Nothing too clean here on that. Down closed candle here. What is this doing? What's this doing? We have this shaded area. What did I just show you on the Dow chart? How do we disqualify an order block? If it's trading outside of the range that we're specially focusing on, what is it doing here? It's outside of that shaded area. So am I going to look at that as an order block? No, I'm ignoring it. It's not there. So where's the down closed candle? There. What's the price level that's most important? The opening and mean threshold. So there's your 2 price points. In between, I'll teach it. In between the opening of an order block that's bullish here, there, and mean threshold. There's your body, okay? Did this wick through the lower end of that shaded area that we're drawing our attention to? No. Does it wick above it? Sure it does. But we don't care about that. That doesn't disqualify this order block, okay? From the opening down to the low, that's mean threshold, okay? Between the opening to mean threshold, in that area, that's where your order block entry can be utilized. That's where you're going to focus your attention on and where your entry would be ideally taken. What I do and how I use it is I will enter at that opening price or as it smacks that candlestick's body. My stop is below this low here, and I want to see, does it respect the mean threshold? What can it do? Mohawk through it. So you have to be allowing that to happen. But look what it does on this candle. It opens, trades down, doesn't even touch the mean threshold of that candlestick's body, and then closes up here. What does that tell you? You're on side if you're long. Don't get shaken out of it. Reach for that relative equal high, which is up here. These relative equal highs right there. See how clean that is? It's so pretty. It's perfect. Smooth edges, if you've never wrote it down in your journal, smooth edges like to be made jagged. Everybody will see this area here and say, oh, that's real nice. That's a resistance. And what are you going to put above that? Buy stops. Because traders want to see that as a breakout to go long, because that'll be what? Resistance broken. Or people that are short, that's where they're going to stop their trade out at. They're going to put their protective buy stop there. So that's where the market's going to reach for. And you see it doing it here. But inside these shaded areas, you can start breaking down price action a lot more refined than if you just simply ignored it, because a lot of wicks scare people. To me, it draws attention. It's like sharks in water that's chummed. Okay, you can in Fiji. I've been there, and I have a rub, not a rub burn, but I have a burn on my leg where I have had a shark rub me and it left a scar. You can be next to these big porkers, okay, and you're in a cage. Even in a cage, you're scared shitless. They're so big they look like Cadillacs come at you. They're big, and their scales are rough. And when they bump against you, it takes some skin layers off. It tears you up. But you don't want to be in a water that's chummed with fish guts and blood and shit. Okay, so they make sure that you don't have any cuts, no nicks, nothing like that, because any little bit of blood will get these some bitches crazy. Wicks are like a chummed water. It's like an invitation. It's like a dinner bell for the sharks. Okay, algorithm's going to go in there, and there's going to be a lot of algorithmic price delivery, or not price delivery, price entries with algorithms in this area, in this shaded area. That's what's going on in here. A lot of high frequency trading algorithms are in that business. And retail traders and the things that they try to use to trade with, they're getting chopped up because they're not seeing it the same way. In here, what is this? Inside this shaded area, what is occurring in here? That high to that low. That's our fair value gap, right? Correctly identified, right? No. What's this? Volume imbalance. You have to include that. What is that small little deviation below it? A mohawk. To get that low price, which is this closing value, which is 32,803, it's got to go below that over here. And that's 32,801. So 2 points below it. That factors a spread. So that way, to get this price booked for any algorithm that wants that price, the algorithm that books price has to offer that price and lower. Otherwise, the handshaking algorithm that the central banks use to fleece everybody that doesn't believe they don't exist, okay, that's what's going on. Okay, that's exactly what's going on, folks. That's what makes these markets go up and down. That's the real dance. And everybody else is a casualty of war. Yeah, sure, you might get a victory here and there. They want you to talk about how you won money. They want people to keep investing their money in their 401ks and all this bullshit, because that gives them a great source of food that never expires. That high frequency trading algorithm entity that handshakes with this rigged market, that's what's going on every single day. All day long, every fucking day, even on holidays. Even those little truncated times of the day or trading days when you can only trade till 1 o'clock or 12 o'clock and they cut the trading off, they're running then too. Their money never sleeps. But in these choppy points, these high frequency trading algorithms are chewing up everybody. And you think this is all noise. Oh, it's getting tight. It's getting tight. It's getting tight. Oh, the chop is real. The chop is real. That's funny shit. I love it. It's comedy. Because in that very moment, I'm in there taking trades. You will start seeing this when you start looking at it. But if you look at it as chop and you think, oh, this is going to harm me, or there's no rhyme or reason why price is doing what it's doing here, so therefore I should just don't do anything, you won't ever see it. You'll have a blind eye. You'll keep a blinder onto it. But everything's happening for a reason. It's all absolutely scripted. So once it goes down to the volume imbalance in here and trades down to this last down close candle, which is a bullish order block, here we start to rally. Then we have, what is this? This is a down close candle, right? That's a down close candle, isn't it? Sure it is. What's the opening price on it? 32,834. And where does this candle go to? 32,833. 1 point lower. Why? Because to get that price, it has to drop low enough so the handshaking high frequency trading algorithms can get that price booking right on that opening. But it's buying selling pressure, right? GAN had its day, and everything in GAN and Elliott Wave were working today, but support and resistance and the guppy patterns don't work today. Harmonic had to take a day off because Hurst cycles. That's the flavor of the day, right? You guys are fucking crazy if you believe that. Like, you honestly believe that Mickey Mouse level bullshit. Come on, man. You gotta wake up. If discussions like this and examples like I've shown all this year and last with real executions, okay, they're live executions, folks. You can't Mickey Mouse that shit. That's real. That's fucking real. You can't hide it. You can't discount it. It's not market replay. They're really happening. And it's the same logic being repeated over and over and over again. That should inspire you to dig into it deeper. Say, you know what? There's something else going on here. All these classic chart patterns, head and shoulders and bullshit, bull flags, that's all stuff that is simplified. So that way everybody thinks they can easily go out here and do it, and they risk their money. And then what happens? They don't want to talk about it to their friends. They don't want to tell anybody they lost money trading bull flags and head and shoulders patterns. So it perpetuates what? When nobody's losing any money. Everybody only makes money. So new suckers come in and they use that same bullshit in books that does not fucking work. Okay. Now, it doesn't mean you can't make money trading with all that nonsense, because you can throw dice or flip a quarter, and if it goes heads up 3 times in a row, and that's a buy. If it goes 3 times tails in a row, that means you should be selling short for the day. If you risk very, very, very little money over time, you can still make money. Does that mean that you should trade that way? Fuck no. But there's a lot of people out there to do that. And that's essentially, in my opinion, what everybody else is doing with every retail thought. Any kind of pattern for pattern's sake, stupid. Moving average crossovers, fucking stupid. Stupid. That can't be the only reason why you're getting into a trade. You can't just do that. There has to be some idea of where the market's going to go. And everything, if you think about it, take a step back for a moment. Everything in your learning about trading has always been about getting into a trade. And this industry serves that shit up on a platter all the time. All these buy and sell signals, because the action part of it, that's the itch that you need scratched. I'm not going to fucking babysit you. I'm not going to sugarcoat it and say, here, watch my fucking videos. I'm going to give you entry techniques over here. No, I'm telling you where the market's going to go, why you can trust it's going to do it, and why you don't have to worry about the fucking algorithm stop working. Who's going to sleep better at night? The person that is wanting to understand how to get into a trade in dozens of different ways, or a person that knows where the market's going to go consistently every fucking week, every single week? This is where the market's going to go. I know this. If you understand that, if you understand where the market's going to go, why it should book that way, guess what happens? Guess what happens? That's when your retail shit is going to work in your hands. But see, nobody looks at it that way. They look at it, well, this is the pattern, this is the methodology, and I have to stick with my edge. You have to keep pushing your edge until it doesn't work. That's how you make an edge dull. That's how you make an edge dull. You overuse an edge, you make it dull. You have to know when to use that edge. You have to learn how to handle that edge carefully and safely. Otherwise, you're going to cut your own hand off. And what good is it if you cut your hand off, you can't push the button, right? So anyway, that's enough about that. I can't stand fucking Dow, to be honest with you. It gets on my nerves. Let's take a quick look at gold. Mix it up a little bit here. All right, look at that fucking mess. All right, so let's go to a daily. Now, right away, if you haven't already learned this from me, this is a market that I have taught many times that it's an event-driven market, which means it's highly manipulated. It's at a value that is extremely absurd, because gold should be like $20,000. Okay, that's what it should be at. Okay, there's not a lot of it right now, but they're keeping it artificially held at bay because all the central banks that they're getting ready to roll out, and the currencies that are going to come up and rival against the greenback that will be gold-backed, the BRICS nations currency they're getting ready to put in play, that's going to be a gold-backed currency. And that will be a death nail for the dollar, because we're backed by bullshit, a hope and a prayer, a fart. Basically, that's what it's backed behind. Okay, so there's nothing behind it anymore. The Gold market, we talked about how it was likely to reach up above relative equal highs if we took that out. And then right over here, keep your attention right in there. And don't take my word for it. Go back and listen to the videos and the commentary. And we did, in fact, trade into it rather handsomely there. So let's talk about things from the perspective that things escalate overseas. Okay, say the tensions in the Middle East get really, really ramped up, and things get just really ugly. I do suspect that would cause gold to rally, but I don't think it would create like a meteoric rise. But eventually, when the BRICS nations really get moving with their currency that they're trying to get more nations to be a part of, once that's in play, you're going to see a steady rise of gold. It's going to be like a commercial bull market, basically. It's going to be one of those markets that just keeps going up, and people that try to short it gets grinded down to bits. We're not there yet, but that's where I see long. What all of you hope for Bitcoin, gold's going to do that. That's what I'm saying. But it's only going to last, a number of years, and then eventually it'll, hurt a lot of people. But gold is going to be one of those movers that just keeps going up, keep going up, and everybody's going to try to look for reasons to go short on it, and it will fail them. But the catalyst, and here's the part that people are not going to use in context when they take my little sound bite right there, and they're going to say, look at this, ICT said this and this. The context is this: the BRICS nations' currency has to be put in play, and more nations are part of it. Once that occurs, you'll see the dollar fall to that because there's nothing behind it. The only thing we can ever do was do wartime, or it's backed by oil. And Saudi Arabia is distancing itself from us, and it's allowing other nations to buy its oil outside of the dollar. So what do we have behind our currency anymore? Bullshit. It's smoke and mirrors. So it's important to understand that a lot of you crypto guys think that you have a safe haven in Bitcoin. They're letting you believe that, because when the central bank digital currencies come out, your Bitcoin's getting sliced and diced. Okay, that's the way it is. They're putting it in futures contracts, and now they're doing ETFs or something like that. I think I read. Whenever that happens, that's absolute control. But you think you are in a free market, not a fiat currency. And it's a fucking fiat. There's no difference between that and what the dollar is right now. Hope and a prayer. Hope and a prayer. Doesn't matter how many Bitcoin are in existence. It's an illusion, and you're buying it hook, line, and sinker. Period. It was used to invite and allow for the idea of something on the blockchain, which is going to be the thing that none of us want to be on. And that's all I'm going to say, at least on this medium. All right, so it really isn't any interest beyond this. Do I think that gold goes and rallies up into consequent encroachment of this wick here? Depending upon how fast we get there, that would be where I would look to see gold go to, right in here. And then if it's real quick and it closes above that, that would indicate that it's going to continue moving higher. But I wouldn't want to short gold, and I don't want to buy gold here. Okay, but gun to my head, I'm telling you, longer term, 10 years from now, gold's going to be significantly higher than it is right now. Would I want to buy it at this level right here? No. Do I think it's going to go higher from here? Yes. It's prone to have a lot of whipsaws, a lot of deep retracements, and that's why I don't like it. And because it's highly manipulated, to me, it's the equivalent of Japanese yen. And Japanese yen is, to me, a villain. It's the final boss in Forex because it's constantly, just doing things that hurts traders that want to hold on to it. And they do this like really wild spikes. Just look at it the last couple weeks. We've done it a couple times. All right, so we've done ES, Dow. Let's look at Euro. Let's go to dollar first. We ain't looked at that. We should have started that, to be honest with you. But the whole core content of today's discussion, I wanted to talk about that trade this morning on the NASDAQ. And it's 2 o'clock and I'm about 2/3 done. Getting your money's worth here, baby. You know it. All right, so we have this original fair value gap that we talked about. We're inside that again with a down close candle, which is potentially a order block. We also have that run below here with this. So this, again, because of all the things that are going on, and that's why I'm watching a lot of things, and this is the number one reason why I have cut short my 2023 trading to where I would normally be trading 2 more weeks. I'm not doing it because all the things that are happening all around the world, so many different wars potentially popping off. We got one, well, Taiwan's going to get invaded, before our election time next year. I'm not convinced we're probably going to have a normal one. The idea of Taiwan being invaded by China, that's still on the table. Our interest in defending Taiwan, militarily speaking, we've committed to do that. We're also heavily vested in the Middle East with defending Israel. And there's so many things popping off, and we are being thinned out in our country. We're giving away weapons. We're giving away artillery. We're not making any more. We're letting people into our country that are, who knows what they're here for, and we're not equipped to have all that stuff. So we are watching the destabilization, which what the U.S. is doing many times for a long time over the Middle East. We're watching that actually happen to the U.S. right now. And if you can't see that, then you're blind. And I don't know what the immediate ramifications are going to be between now and the end of the year because of all that stuff. I certainly know that I don't want to be in there taking on risks because we could have an event that could be very problematic and shocking, where I don't want to lose $1 million or more. I'd rather not do that, right? So if I choose to stand on the sidelines and observe, I can be more calculated about going into this new year, because I have to be very careful trading next year too, because all this stuff isn't going to go away. So I have to be very careful and pick my shots and know what I'm doing when I'm doing it. And if I know I usually take the week right before Thanksgiving in the U.S., I don't trade after that for the rest of the year. I don't do any kind of trading at all. And very rarely did I look at markets. But when I started doing mentorships, I had to be teaching them, and it was such a drain. And I'm looking forward to having no connection to the marketplace until February. So my trading starts the first Tuesday of February in 2024. I won't be doing anything in January. I won't be doing anything the first week of February until we get to the first Tuesday. And that's the mode of operation that I've used throughout my entire career. I don't want to do anything in those other times because it's holidays. I want my focus to be on that. Your focus should be on that too. And where we're at right now with the dollar index and all the things that are going against it, my thoughts are this: the Fed would keep causing reasons for the dollar to go up. That would eventually, in their typical perspective, where people look at it, the way you fight inflation is that you drive down the costs of goods. And how do you do that? You raise interest rates, and that way homes aren't willing to be purchased because the mortgage rates are too high. So that cools the purchasing interest in real estate. Commodity prices are suppressed because the higher dollar causes the cost of manufacturing, producing, or housing, or insuring commodities. It causes that increase to be detrimental to those commodity producers or manufacturers or insurers. So therefore, the price would go down. But we're in a weird, unique position in history right now where we are seeing controlled and orchestrated famine. So while the dollar can be going up, and it has been going up, commodity prices are saying we're really not going to go down because it's expensive for a reason. It's famine. Okay. Just a shout out to my charter members. Look at the sugar market and look at the cocoa market. Remember what we were looking at a year and a half ago? We're there now. Okay. So those big runs higher, look at meat, look at feeder cattle. Okay. Wait till you see we get into January when you see what happens in the cost of ground beef and steak. You like to eat meat? Well, it's going to get extremely expensive going into next year. Really expensive. And the intent is for you not to do it. They don't want you eating meat. That's a delicacy. They want you eating bugs. Okay. So all those things are impacting the macro on determining what these markets are going to do on a longer term basis, which makes it what? More difficult. Not to trade, intraday, because that's we can thrive in intraday price action. It doesn't matter if anybody's eating bugs or not eating bugs. If the BRICS nation comes forward with its gold-backed currency and everybody else but the U.S., Canada, and Britain joins them, who cares? That's irrelevant because intraday price action is intraday price action. There's always bread and butter to be made there. But on a higher time frame, like reading the daily chart on the dollar, that becomes harder. We can stay in a long-term, prolonged consolidation here. And other currencies could be allowed to trade wildly. And that's the control aspect of keeping the dollar in a consolidation. Your crosses like euro pound, yen, pound yen, Aussie, New Zealand, all those exotics, they will have extrapolated price moves if the dollar stays in this consolidation on the daily chart. So none of you should be looking at dollar-based currencies if you're a forex trader right now. You should be looking at the exotics, anything that's not with a dollar in its name. That's where your focus should be right now. Because looking at those markets and looking at their interest rates, which one has the higher interest rate? Which one has the lower interest rate? And finding currencies that have a higher interest rate coupled with a currency that has a lower interest rate. And be long the one that has the higher interest rate in that currency. That's how you do it. Okay, that's how you trade interest rate differentials. But you just don't trade higher interest rate differentials for the sake of doing it. You have to do it at a time when the dollar's being in consolidation. Hello. So it's not just fractions. Okay, there's other things you have to look at too. That was the part that was left out of Steve Morrow's stuff from my 1996 concepts in study notes. You're welcome. That was tossed in for free too. So let's look at a 4 hour. All right, you see how we've already taken the sell side here with this drop? We're inside that fair value gap. It's the blue area here on the daily chart. I don't like the idea that they left this like that, but let me map it out for you like this. Let's see it. Do you see how this area right here, all this sell side imbalance, buy side inefficiency, or SIBI, on this one candle is being framed with this candlestick's high, that candlestick's low. And if you extend it over across all these candles here, where is the inefficiency at where it matches both sides, the downside and the upside? Where do you see it at? You see it here, right? See that right there on this candle? So in other words, this part of this down close candle and this part of this up close candle, it kind of matches right there. You see that? Don't pay attention to that. Look at it here. This is discount. So this portion of this down close candle and this portion is up close candle, that is a balanced price range. It's further increased in terms of its balanced price action is we took this low out here and rallied back above. So what I'm saying is if we drop outside of this fair value gap that's in blue, I would demand, that's the real supply and demand. ICT supplies the mojo and he demands price does what he wants it to do, right? I demand the supply and I supply the demand. So if we have this area here as a balanced price range, if we trade outside of this, this needs to be the last line of defense and it should not close above this lower level at all on the 4 hour chart. If it does that, that means that we're going to see lower prices on the dollar index and it'll probably need to trade a little bit beyond outside of the consolidation it has on its daily chart. But as long as we don't do what I just stated here, which is close below this balanced price range on the 4-hour chart, then we're going to stay in consolidation. It needs to trade above these highs here before I would resume looking for order flow bullish. It needs to get